Um, I'm Stuart. I'm the CEO and founder of Marble. Marble is a digital wallet or digital hub for all your insurance. So property and casualty, home, auto, life, health, dental, we pull it all into one digital account. We're just on the web today, but hoping to launch a mobile app soon. And from that, working with our partners here at Young Alfred, you can shop for new rates, you can pull in information, see reviews, and just keep everything organized across your household in one account. See what you need to protect, your assets, and then put those policies there that protect them, and just have that seamless sort of mint for insurers experience. And I'm joined by David Stacy, who can tell you about Young Alfred, who's been around a lot longer and probably has a better description than I do.
Getting some gray hairs, I guess, in insurance. Been in the industry about 5 years now. So I'm a co-founder of Young Alfred. What we are is a platform to compare and buy your personal lines insurance. We really kind of specialize with the home insurance product, but you can shop auto insurance, flood, earthquake, umbrella, really any product you can buy from your local insurance agent in the personal lines category, you can buy through us online. What our approach has been since the beginning is build a very consumer-friendly, non-spammy shopping experience. So you can fill out an application, get quotes, and buy all without ever getting cold called or having to pick up the phone and talk to someone. We're live on youngalfred.com if you want to check us out there and shop for your home or auto insurance. You may also start to find us in other partner flows like your mortgage lender, your real estate brokerage, or partners of ours like Young Alfred, where we are powering the experience, but in a more white label fashion.
Yes, and that's how David and I first met when I was running insurance at a mortgage lender. We started to talk about that flow, and that was really where I started to learn about insurance and learned a lot from David and his co-founder Jason. But today we're not talking. Last time, check it out on YouTube if you have 40 minutes and want to learn about homeowners insurance. But today we're talking about auto insurance, which I have not sold a ton of. I know a lot about it. I've got licensed as an agent. I don't have it personally because as a native New Yorker, I didn't really even start driving until I was about 25. So I really only understand it in the academic sense in insurance, but I think that'll make it a good discussion because I think you probably know a ton more about it in operations, and I can tell you the textbook definition of various hazards or whatever, if that's useful. And I think specifically to make this most useful for people if they're watching now or they're watching in the future, what we really want to talk about is like what goes into your rates. These rates, auto insurance is sort of unique in that it's typically rated every 6 months as opposed to every year where you would expect a year for homeowners or renters or whatever. But auto is typically every 6 months for most carriers. And that is not the only thing that's different about it. It has a whole other set of underwriting factors, a whole other set of considerations, and even technologies you can use to change your rate. I think we'll probably spend the next 30 minutes or so getting into those and with the goal of helping people feel like they can take control of their rate a little bit, or at least shop around to the point that they can get a better rate. So with that in mind, maybe as a jumping off point, David, I'll just do, typically this will be more conversational, but we'll do the first one in a classic Q&A format. What does like boilerplate, standard, off the rack auto insurance cover? What should people be expecting to be covered for when they have auto insurance?
Yeah, good starting point here. So I would break it down into 3 categories. A policy is going to consist of some form of liability coverages, and states are going to have minimum liability amounts that you have to have in a policy. And generally it's a best practice to buy more than the state minimum if you can afford it. Then you're going to have the coverages that protect your actual car. So those are going to be comprehensive and collision coverage. And then there's mostly like in all other category add-ons. You want roadside assistance or rental car coverage. Those don't impact the core policy as much. So look, if I'm going to come back to the top and think about the liability coverages, oftentimes, so first, like what does the liability coverage really consist of? There's bodily injury coverage. So if you get in an accident and someone has to go to the hospital, they've got pain and suffering, some sort of medical expenses associated with injury to a person, that's what your bodily injury liability is going to cover. And then you're going to have property damage liability. So if you swerve off the road and drive your car right into a brick wall, the property damage liability is going to cover the cost to rebuild the property you just damaged. A lot of states have minimum amounts in the call like $25,000 range of liability limits for bodily injury and property damage. Look, if you get into a bad accident, these bills can rack up into the hundreds of thousands pretty quickly. So, where we tend to recommend liability limits, assuming, look, price is always a consideration here, but is 100,000. It's kind of oftentimes broken down into like 100,000, 300,000, so $100,000 in coverage per person and $300,000 in the aggregate of total damage. I'll pause there before jumping into the actual collision and comprehensive coverage, because there's also other layers to unpack on liability insurance within.
Totally. Yeah. I mean, I think liability, as someone a little bit newer to insurance, liability is the thing that was really the biggest eye opener for me, and like the value of insurance. Like value is measured by like what it gets you when something when you have to make a claim. Because like I think my stuff gets broken, my stuff gets fixed or replaced is like kind of intuitive. That's what a warranty is too in many ways. You get replaced or but like getting licensed as an agent, this concept of liability, especially when you look at a policy, you would typically see like these big numbers under liability. You'd be like, what is this? Like, can I just like slash that out and like say, and it's like, no, that's like really like a lot of the utility of these policies, because like what the insurance company is basically saying is like, if you with some extenuating circumstances, like we will go to bat for you up to this amount. And that particularly in the US, which is like a pretty litigious market, like is like a very valuable piece of coverage to own, particularly when you're driving, which is like where I would have to imagine over 50% of liability claims are happening, given just how many miles are put on the road. The other thing I want to quickly ask about before we get into or touch on is this other thing that you may see, which I don't believe is required in every state, which is this like uninsured motorist coverage. And that is, and David can voice over where I'm wrong, but basically this idea that if you do have an accident with someone without insurance, this is another consideration and carve out in your policy, and you will be covered for damage they do as well, or the damage they do to you. That's what I can't remember.
Yeah, so it's the damage that they would have been liable for, but they can't pay because their insurance is not covering it. That's where your uninsured or underinsured motorist comes in. So I haven't seen the latest stat, but I remember a couple of years back, I saw 1 in 8 drivers on the road is uninsured. Yeah. It's probably basically the same number still, but you want to have that one, because look, if you get in an accident with someone who just has no money to pay for the damages, like you can't sue them, and there's just no one to pay the claim. So that's where your uninsured and underinsured are going to kick in.
And I can't, just like California, does some states even require it, or New York require it?
Yeah, so every state does have their own minimum. Some require it, some do not. And the way each state operates can significantly drive the premium
cost
differences. Yeah. So, Michigan is a state that has quite a bit of regulatory oversight and forces some pretty high coverage limits on the medical side. And, a lot of people are uninsured there because they can't afford $6,000 a year for their insurance.
Exactly. Yeah. But you always see that in like articles about auto insurance rates and things like that. But uninsured coverage is typically would maybe required or would be something that you could add on if it wasn't required to a policy. I mean, if you were
Yeah,
buying
I
it
would
for your
always add that on.
yeah.
Yeah.
Sorry, but do you now I'm serving you up a meatball here to get into your thesis, your the big show, comprehensive or no, yes, comprehensive versus collision.
Yeah. So look, first, collision is going to cover you getting into an accident with another vehicle or object. So you crash into a tree. That's going to cover the damage to your car. Important to note that the replacement will be done at market value. So that's where you often hear, oh, the car was totaled. So you end up not actually paying damages to repair your car because that costs more than the actual depreciated value. Uh, in some instances, if you have a new car, like within a year old, carriers will offer new car replacement. So if you get into a bad accident, they'll just replace your entire car brand new. But that's going to be collision. And then comprehensive, the easiest way to think about it is essentially anything else that can happen to your car that is not a collision. So vandalism, broken windshields, someone stealing your car, that's all going to fall under your comprehensive coverage.
Yeah.
Look, wear and tear, generally in anything insurance, is not covered. So, just because you've run your car to the ground doesn't mean you can put in an insurance claim. And you are going to have a deductible on these policies. So, reminder, insurance language, what to define deductible is essentially the amount of money you will pay out of pocket before your carrier kicks in and makes a payment. So if you have, call it $1,000 worth of damage and your deductible is $500, you will pay $500 and your carrier will pay $500 to fix the damage.
And in my, just as a quick, and we're getting a little bit ahead here, but my memory is that from looking at quotes is that the deductible is like one of the most powerful levers to control price at the end of the day too.
Yes, it is. Because you're much more prone to file a claim if you have, $100 deductible, because $300 worth of damage, you may just decide to file a claim, and carriers know that. So they also understand if you have $1,000 deductible, it's going to take a lot more damage for you to actually go and process that claim. So if you are pretty tight on your payments and looking to save some money on your insurance, assuming you can afford it, we recommend increasing the deductible. It does come down to, if you have to pay $1,000, is that going to put you in a tight spot? And if yes, then you might want to rethink raising your deductible and just pay for more insurance. The other quick point on these two coverages, you do want to factor in like how old is your car? Do you really even need it? Because if your car's depreciated value is effectively like $2,000, you may end up just paying more money to have collision and comprehensive coverage. And, after you factor in a deductible, then it's even worth.
Yeah. I sort of distracted you though, talking about comprehensive and collision, but I think we sort of covered it.
Yeah.
We didn't really get into collision. I don't know if you want to like drill into that more. We could also sort of mix it up and talk about like the savings piece of the puzzle now, like keep going on this thread of deductibles and other ways that you could lower that rate. Maybe just like, actually, if I'm looking at 3 rates, like, so again, like I don't drive, I take the subway everywhere. So both a preference and like sort of an annoying part of my personality, but I do look at insurance rates all the time, and I look at auto rates, and like this classic sort of kayak model, right, is really taken hold in insurance. I would argue for the better, and it's not exactly like kayak. There's a lot of context. It's not just buying flights, but consumers want and should be able to see multiple quotes against each other, right? Like, and that's not an unreasonable thing, and it's how people make competitive decisions all the time. But like, you have the thing about insurance, right, as compared to even a flight, is it's like you have a lot of variables. And I think, young Alfred does a good job, and in turn we try to like normalizing some of those numbers, so it's a little bit apples to apples, but still, like, you look at a snapshot of 3 rates, what is like the first number on the page you're looking at? And then if that one's price, what is like the second one that you're going to look at?
Yeah. So first is price is always going to catch your eye first, but that can be very misleading because you do want to make sure you're comparing apples to apples. The auto market is standardized coverages, across states, across carriers. Generally, they're very similar. So you what you want to make sure you're doing is lining up each coverage and comparing it side by side, because it's very easy to find, generally pretty easy to find a cheaper price policy, but you may be sacrificing coverage. So
Yeah.
the challenge is lining up the liability limits that are the exact same, the deductibles that are exact same, and these other kind of add-on style coverages, and making sure you understand if you're going to make a change in Swiss policies, are you removing something that's important? So I would always, like, if you currently have existing insurance, pull up your old declaration page, ask your agent to do this, review, do a side-by-side check, and make sure everything is, aligned apples to apples. Otherwise, the price can be not very meaningful.
Yeah, I mean,
quote to quote.
well, there's a couple different like anecdotes that led us to build Marble, and I'll try to curtail this pitch like to its feasibly small amount. But like, I remember talking to consumers all the time at Better, and this is a large part what also Young Alfred is built on the quote side. But in terms of holding that existing policy up against what you have today, we would have these customers who would just build spreadsheets on their own. And they put all their policy information, all their coverages that are deductible, and then they just punch them in, and then they just look at the price. Because it is, to some extent, I mean, unless you have a really bad customer experience or really good customer experience with a carrier, a commodity transaction where you're looking for the best price risk for your policy and your assets and your driving behavior without giving up too much coverage. So, one of the reasons we built Marble so people can collect all their old policies, so that when you get a quote, through our site partnered with Young Alfred, you can then just look at it all and make sure that you're not suddenly jumping up to like a $1,500 deductible that drives that price way down. But when you have a fender bender, you're paying for the whole thing out of pocket, which sort of defeats the whole point of having coverage, unless that's what you choose. But it's funny because that's not a particularly that still is probably not the standard way of transacting for insurance in the space today, right? Like, I think probably 6 out of 10 insurance transactions are still done kind of on just like, you get a quote or two back, and that's about as much context as you'll get.
Yeah, that's accurate, because there's still very few consumer flows where you can do everything centralized in one experience. Most of what you'll find is different lead generators out there promising quotes. You go to get them, and then you just find yourself on the carrier's website. So you have to fill out the same form a number of different times. And, in a way, as a consumer, act as your own insurance agent if you're not going to work through kind of a local independent agent.
Yeah, exactly. And that's like, it's very interesting how technology has also intervened there, but also what people expect technology should be able to do versus like how hard it is to actually build this in insurance.
Yeah, that's the challenge. Expectations in other industries, like thanks to Amazon, make it really hard to quickly meet their demands in insurance. And also, like, insurance isn't one of those things you necessarily want to make one click. Like, I think that's a goal a lot of people are marching to, but sooner or later, if you're sacrificing coverage just based on price, like, you're going to lose that game over time, whether you're the marketplace model or the carrier.
Yeah, that's even for auto insurance, which is maybe the most frequently purchased. It's on top of everyone's mind. Like, there is a point at which talking to both a licensed agent or peers, there's a lot of things that people do in this transaction that correctly prevent it from just being a one-click transaction, right? Like, it's not like quite as simple as just like checking the box for an extended warranty. You do need a little more context, because like, it is this thing when something goes really badly, you want to make sure that you have all the coverage you expected. You don't want to have just been like, see an arrow that says, oh, I can save you 60%, and then again you get into an accident and you're paying out of pocket.
Yeah, no, you brought to mind one of the other just like notorious things that make purchasing auto insurance difficult on the consumer is forcing the carriers to pay substantial fees to run motor vehicle reports. So
Yeah,
that's why oftentimes you will get asked, what is your claims history? Who lives into the home? And a lot of
interesting
data that is actually out there, but it is prohibitively expensive for carriers to run every
to
time you're
pull
running
that
a quote. Yeah. So that's where you, as a consumer, maybe going through, you get some prices and then it changes as you go to buy.
because then
Um,
they're finally pulling that information and they're saying like, oh, hey,
yeah,
you left this one accident off or whatever.
it feels like a bait and switch. I blame the states for this. It should be free. It's consumer data. Why do carriers have to pay for it? Um, Maybe one day they'll make that
Maybe one
change.
day.
Yeah,
Maybe one day. There's another startup idea. I mean, it's not a very good one because it's be free, but for someone who wants to lose a lot of money and then give it to us for free so we can
yeah,
quote people
please.
more cheaply. Yeah. Um, well, so talking about technology, this is actually sometimes I say it's a good segue, but I'm lying because I don't have a better transition. But this is a good one. So like technology has come into the car, right? Like, like people have tracking on their phone, the cars have all sorts of technology. And you've seen, Root and Metromile are the first two big public players on the public markets doing telematics, I think. I don't know that there's anyone else.
I would caution you to say that Progressive's been the
Oh,
first
yes,
one
Progressive, of course, yes.
way
Yeah.
back before anyone else was doing
Yeah,
it.
Snapshot was
It was
in
like,
there
yeah,
in
but
market, exactly, yes. Let me reframe. The only two dedicated pay per mile. But
yeah,
yes, Progressive has had their own pay per mile program, and all states had DriveWise too. So there's been players in the market, though I don't think I don't know if all states publicly traded. Anyways, I mean, is that always a better deal for me? Like, I guess like the two personas here that come to mind for me are like, maybe there's me, let's say I had a car, let's say I was driving, twice a month, and then there's you, and let's say you're commuting to the office. What is that model of like, because I think even on the Marble side, right, we've had to change our data models because it's like you get 3 State Farm policies in. It's like 300 a policy, here are the rates. And then you see these like, you see like a route policy and it's just like this many cents per mile. And you're like, well, how many miles am I going to do? What is that? It's a hard thing to compare because you see like 16 cents a mile. And you're like, well, that's not bad. But like, it can't be that. There has to be some trade-offs.
yeah, there definitely are. I think we're still pretty early, even as long as these models have kind of been around, still early in proving them out. Price wise, you always run we got into this on the last call, kind of like the adverse selection model where you're getting consumers that maybe just aren't driving that much, kind of falling into your category. And the other thing is comparing the premiums and what is the carrier's approach to changing your rates depending on your driving behavior. So we see some carriers, in our mix that if you opt into their telematics program, it's an automatic, call it 8% discount.
Okay.
And they're not going to penalize you based on your driving. They are ultimately just looking to get that data and help them price their entire book of business more effectively in the future. There are others that will change your price depending on your driving, and that can be rather significant. So, look, what I think you want to, if I'm a consumer kind of evaluating these different options, do I go with a carrier that has kind of the standard auto insurance model, or do I test out one of these pay per mile models? It's really going to come down to how content am I with the price I'm currently paying and with my existing carrier, and has that been stable over a long period of time? Because as soon as you get off of them and jump to one of these other models and say they penalize you quite a bit, really to no fault of your own on renewal, then you're going to find your rates are increased if you want to go back to your carrier because you lost a discount in terms of just the tenure you have with your existing carrier. They will see that you're one of the large actual rating factors tends to be how long have you been with your previous carrier.
Yep.
And
Yep.
they want to avoid consumers that are switching every single term trying to find the best price and, show that you've been around for at least a couple of years. So you do take a risk by trying those out. But if you're sitting around going, I am way overpaying for my auto insurance, they just hiked my rates, like give it a shot. You might find your rates significantly better.
I mean, if I'm not doing telematics, I guess, the standard discount things that I could expect to hunt out, would be, staying with my carrier is obviously one that we see, but probably like theft protection. I'm trying to think of like the things that you would want as a driver to make sure that you're bringing to either an online shopping experience, or you're making sure you're getting credit for all the discounts that you should earn. Because sometimes these carriers, they want to give you the discounts, or they want to give you the rating advantage, but like they don't. There's just not an opportunity to tell them. So like, anti-theft, probably where you park the car has some role in it.
That does. You want to be honest with that.
We'll
try and put a different zip code that's not the same as where it really is.
Or anything about like braking? Are there any other technologies that people should make sure they flag?
Yeah, there's the anti-lock brakes. There's a number of factors where most of them are almost automatically being included if the car is newer, because they're just built into the newer cars.
Yeah.
But really where your most significant opportunity on savings is going to be is, one, do you have another policy with the carrier, notably home insurance? Could be renter's insurance. Oftentimes you find the discount essentially pays for free renter's insurance.
Yeah.
So, are you saving a ton of money? Maybe not really, but are you getting a free renter's insurance policy? Yes. Accident claims free, that is a discount. Loyalty, kind of sticking around with the same carrier. Some of them have programs like vanishing deductibles. So the longer you stick around with them, there's no charge to decreasing your deductible. And there's that for newer drivers, passing kind of like a driver's safety course. That also holds true for senior drivers. Once you pass a certain age, just getting a certification. And then, good grades is still a discount for.
Really?
Yeah. It's usually B or higher.
How long do you have to be out of school?
I don't think you or I can still get.
I don't think I can take any grades back. I can't. Okay,
yeah.
That's fine. I wasn't getting a lot of B's anyways. I wasn't doing much better. I was doing poorly. That was the point. I don't know what that point was. Anyways, I haven't been in school for decades, so I've seen that on some of the discount pages, good grades, but I wasn't sure like how someone, I guess it's like if you're younger, if you're in college, maybe.
Yeah, I couldn't have applied for it with my business school grades, but maybe my undergrad grades.
Yeah. See how far back I have to go. Get my mom to send a report card in. So then there's a question here that's a good one that I think is funny because you drive, presumably. I mean, living in Arizona, I presume it's sort of part of the daily life. What are the what would we both make sure to have in our auto insurance as people that work in insurance? I think for this format, I'll go first because it will provide some levity, because I only, again, know these things on the quotes I get. I don't drive a ton. Or more, it'll just provide a counterpoint maybe, because I think we may have different perspectives. But I think for me, I don't have to worry about the loyalty offset of switching today because I don't have an existing policy. So if I were, in whatever hypothetical to start driving more and need a car in the city, I would possibly myself consider starting by testing out one of these pay-per-mile programs. And that has a little bit to do with, again, I don't see myself doing like a lot of commuting driving. It would be a sort of an unpredictable amount of mileage. So I might be able to see some pricing benefit on months where I'm barely using the car, for example. I also I'm inclined to sort of test out, I think it'd be good to start and test out one of these newer technology providers as well. So I think for me, because my driving is and would be very choppy, I may find myself testing out one of these newer telematics companies, seeing how that's going. but again, wanting to make sure as well that I'm getting the one thing that, any policy I get, I have like a lot of fear, or fear is too strong, but I have a lot of apprehension. So I make sure to make sure there's enough liability coverage. Like that's something that I, both for myself and for uninsured drivers, things like that. So that's something that either through, I mean, I think for those telematics companies, you can still get that, or you would do it through like an umbrella policy as well if you wanted more.
Yeah, they'll sell that still.
Yeah. So I think that's how I would approach auto insurance as someone who like works in the space, like knows my own driving routines. But what how do you sort of think about that when you come up for renewal?
Yeah, so I similar to you, I would go very I guess conservative is maybe the right word on the liability coverage and just max out my limits there. So I would buy $250,000, $500,000 limits on liability, partially just because maybe I'm a little paranoid about getting sued. You just never know what's going to happen there.
Yeah.
And there's enough crazy drivers on the road, I think, to warrant that. Where I may differ from a lot more of the population is my view on deductibles and comp and collision insurance. So I would opt for a very high deductible where essentially insurance is only kicking in if the car is totaled. Because otherwise, if you find yourself in the situation where you get these small fender bender style claims that are going on your record, yeah, you'll get a payout, but you're also going to pay higher insurance rates on your renewals for the next 3 to 5 years. So my view is more of almost self-insure on the car unless it's significant damage. That said, one thing we have run into here, so I drive a Jeep and their windows are like very horizontal, and in Arizona,
I see, like they don't,
four cracked windows in 1 year. On the fourth, got to get it replaced. So like we're not putting all those
because
on
there's
insurance.
no. This is just not a physics conversation because there's nothing. They're just going straight into it.
Yeah, it doesn't have enough of a slant apparently because it doesn't happen on other cars as bad. Too much highway driving, so that's where I would not go kind of like the pay per mile just because we find ourselves on the highway a lot. Yeah, quite a bit of miles. But it's one of those things where if I was filing this claim, even though it's like a $0 deductible, which a lot of them have on glass 4 times in a year, you're going to pay for that over the next couple of years on your insurance.
That is, that's a very good point and a very interesting approach too, because like it all goes into this underwriting picture that carriers have of you, right? It's like now carriers want that claims information too, right? So like this is the push and pull that you have. But if you are in a position where you can self-fund some of these repairs, like you can present a more like a different picture when it comes time to re-rate.
Yeah, it's I guess one way to look at it is thinking about likely how much you're going to pay over a 5 or 10 year period.
Yeah,
versus a near term price differential. And if you can self-insure, so to speak, some of your auto insurance, you're likely to pay a little bit less over a longer period of time. But also you have to be comfortable with making those payments.
Yeah. So here's the last question we have written down, but who knows where it'll go. But if I have an accident, and knock on wood, my limited driving experience, I have managed to avoid them to date. We'll see how it goes. This weekend I have to do some driving, so I'll text you on Monday to see how.
Fingers crossed.
If I jinx myself, yeah. Everyone who drives me should have their fingers crossed.
Well, hold on. Can I just? Sorry, I have to throw my co-founder Jason under the bus here. He was driving in Manhattan yesterday, and
already from the jump,
turned the wrong way on Broadway. Luckily avoided oncoming. Yeah, on Broadway. Luckily avoided
arguably in the world the biggest street.
Yeah, he got away unscathed, no tickets, but
Wait, got away? Like, did he?
He went a full block before realizing like the lights aren't facing the right way. Rush hour, like 5 p.m. I just got lucky with the lights. We're around 37th, so.
Nice. All right, man. Well, that is a terrifying story, but kind of a cool one in that he probably has joined a very small group of people who've ever done that.
Well,
He sort of acts, which it should be. Don't go and do that. But
yeah,
as a disclaimer for people who've ever driven, probably not very many of them.
yeah, don't turn the wrong way on a busy Manhattan street.
Yeah, especially not Broadway. We have these open streets up here by us, which they shut down on the weekends, and it's so nice. But I would say like one in every like 10 cars just drives past the barricades anyways, and it's like cool. Like so
Yeah.
just ignore those. Yeah. So I see how Jason it could happen. So if you do have an accident, well, here's actually a lead-in question. Does an accident and being pulled over have the same impact on your rate? Do you know?
They'll have different impacts. So you can tell this when you're filling out insurance forms. They'll ask you, have you had accidents and have you had violations?
Okay.
And then also, are those accidents at fault or not at fault? And depending on which state you're in, that can make a difference or it doesn't really make a difference. So all the different, I guess, marks on your record, so to speak, from an insurance perspective, will have differing impacts on how you're going to get rated. And
yeah,
some of it is also the severity of the accident gets factored in.
Yeah. Okay. So, I mean, if I have an accident and I report it as a claim, is it basically a lock that I'm going to pay more next policy with any carrier?
Some carriers have accident forgiveness. So you get into one fender bender and you've been around with them for a period of time, they will not factor that into your upcoming rates. I would generally assume, though, my rates are going to go up if I've gotten into an accident and if I file a claim, even if your claim is a $0 payout. So realize when you pick up the phone to call the insurance carrier and discuss an accident, that is going to be put on your record, whether or not you actually even got a payout. And $0 claim payouts will hit your record.
Interesting. So it's, I mean, like, and then you mentioned something before about this like 5-10 year timeline though too, right? Like, if I don't have any other accidents for like 10 years, should I expect sort of like something on almost like my credit score? Should I expect that to sort of work its way off my?
Yeah, it will fall off. It will fall off. Carriers, and I think this also depends on state because there are some regulations around it. Anywhere from like a 3 to 7 year time frame.
Interesting. So it really is similar to a credit score.
Yeah, well, credit's also a major factor in rating
your
insurance, but not in all states. California,
not in all states. I mean, I think credit is maybe one of the, to my knowledge, like one of the biggest, certainly non-driving factors in like non-driving based factors in auto insurance pricing in states that allow it.
Yeah, it drives price significantly. So
if you just paid off a big loan or something, and you're like, if you pay off a student loan or an auto loan or something, like, to David's point about like the loyalty being priced into it, like on the flip side, you may re-rate and like give it 60 days or however long it takes credit agencies to populate your new credit rate, but you may see a big drop in your rate.
Yeah, it's a significant driver. And it's one of those things where there's a bit of a vicious cycle of if you have low credit, you're being forced to pay more for auto insurance. And it's harder for you to increase your credit because you are paying more for things like auto insurance. So, it's tough to get out of that kind of circular model. But yes, to your point, improving your credit should decrease your cost for other financial expenses, even beyond just auto insurance. There's just so many things that factor that in to how they're priced.
Yeah. If you don't mind me asking, who's your auto insurer?
So actually with State Farm, still
a classic.
It's a policy I inherited. So
really?
it has not been heavily shopped. Because we just moved out here. So I came from not having auto insurance, and
now you're up and now you're
living Manhattan life now have a policy. So
nice. Yes. Okay. A great policy.
Yes.
I don't think we have any other questions. And we've just been at this about 40 minutes. So I feel like we've run the classic academic window of class. We've done a class now on auto insurance. So I think we can bring it to a close here. But I sort of in summary, if we can summarize, telematics is not a straightforward cost saver. Don't look at it as simply a cost saver. It can in some scenarios, and you should consider it as that, but always look at the trade-offs. Policy coverages, policy deductibles, and all those things that go into the declaration page of the policy quote. Try your best to either use a service like Marble Earring Alfred, or another one or an agency that will give you that apples to apples comparison. So if you are seeing a cheaper rate, you're understanding how it got cheaper. If your credit score increases, it might be time to shop again. Just take a right on Broadway, generally. Don't take lefts. You're always going to want to turn a right on Broadway. And I think that's all I've got, unless you're crossing. That's okay. Actually, strike that. There are, but it's complicated. Not every cross street. Any other things I'm missing from the summary?
I think that was actually pretty comprehensive. I was gonna throw in
comprehensive.
the
Nice.
"be careful on Broadway" joke. Yes.
Sorry.
You snaked me.
Yeah, sorry. Well, you got the comprehensive pun.
Yeah.
So there you go. Excellent. Okay. Well, thank you everybody for joining. This will be on YouTube as well. And I'm going to sign off now. Thanks, David, for joining.
All right. Yeah. Good chatting. See you soon.
Good chatting. See ya.